All right, let's get right into it. What we just saw happen in the silver market, well, it wasn't some random market fluctuation. It wasn't an accident. We're going to break down how a very quiet overnight rule change was actually a calculated shot in a game with incredibly high stakes. And this really gets to the heart of the matter. As one analyst put it so perfectly, this was always the endgame. You see, when a market starts moving in a way that threatens the people in charge, it's not the players that change, it's the rules themselves. So while most folks had their eyes glued to the price of silver ticking up, the real move was happening behind the scenes. The CME group, the exchange that basically runs the entire futures market, decided it was time to quietly rewrite their own rulebook.
So what exactly did they do? Well, they issued what's called an emergency notice. This wasn't a suggestion or a topic for debate. It was an immediate, no questions asked change to the very rules of how silver futures contracts are margined. This was the system firing its biggest cannon to try and stop a runaway train.
Now, you might be wondering, what on earth is a futures margin? Well, think of it like this. It's basically a good faith deposit. To play in the big leagues of the futures market, you have to put up a chunk of your own cash to prove you can cover your bets if they go south. It's the skin in the game that they require.
So here's the thing. That margin can be used as a weapon. It's a pretty straightforward playbook, really. First, you see the price of silver just take off. In response, the exchange comes in and hikes up that margin requirement. Suddenly, it costs a whole lot more money just to hold on to the positions you already have. And that gives you a tough choice. Come up with more cash right now or sell.
And listen, we're not talking about a tiny little tweak here. The cost to hold on to just one silver contract shot up by about 15% overnight. That means if you're an investor, you've suddenly got a call saying you needed to find thousands of extra dollars immediately. The whole point is to drain cash from the market and force people to sell.
But here's where the story takes a fascinating turn. This is the big twist. See, in the past, this tactic has always worked. It was the ultimate price-crushing tool. But this time, the market just refused to break.
Just take a look at this comparison. If you go back to 2011, they used a series of these margin hikes, and the result was devastating. Silver's price collapsed by nearly 30%. It crushed the market. But today, the market took the punch, it stumbled for a moment, and then it got right back up and kept going. It just absorbed the blow. So the big question is, who stepped in? Who are these new, stronger hands in the market? Well, it's not your typical trader who's using a ton of borrowed money. No, these are industrial giants who absolutely need silver for things like batteries and solar panels. They're massive sovereign funds. They are people buying the physical metal with cash. They don't care about margin calls because they aren't using leverage. For them, a price dip isn't a crisis, it's a buying opportunity.
And this really brings us to the real story behind all of this. To understand what's happening, you have to realize that we're not dealing with just one silver market anymore. It's become clear that there are now two totally separate markets, and they're operating with different rules and, more importantly, at different prices.
Here's the breakdown. Over in the West, New York and London, they're trading paper, futures contracts, promises of silver. The price there is all about financial rules and interventions. But then you look to the East, to Shanghai, and they're trading the real thing, physical bars of metal. And the price there is driven by raw industrial demand. And just look at that price gap. A huge difference between the paper promise and the actual stuff.
This has created what the source material is calling the Shanghai Shield. It's like a giant safety net under the price. As long as buyers in Shanghai are willing to pay top dollar for physical silver, the paper price in the West can't just collapse. If it gets pushed too low, smart traders will just buy the cheap paper contracts in New York, demand delivery of the actual metal, and then ship it to the East to sell for a massive profit. That would drain the Western vaults in a heartbeat.
We put a lot of time into breaking these things down, and if you're finding this useful, we'd really appreciate it if you'd like the video, share it, and of course, subscribe so you don't miss what's coming next.
Okay, so that's the financial side of the coin. But what's truly fascinating is that at the exact same moment all this was happening, a completely different game was playing out on the political stage, starting with a last-minute emergency G7 meeting.
And just look at this timing. You really have to ask yourself, is this a coincidence? On the very same morning the CME pulls the trigger on margin hikes, the U.S. Treasury Secretary calls an unscheduled emergency meeting of the world's top finance ministers. The official topic they gave? Securing and diversifying supply chains. It feels a lot more like a coordinated response than a coincidence.
So
what does that polite official phrase, securing supply chains, actually mean? Well, according to the source, this is just diplomatic code. The real unspoken message is one of pure panic. We don't have enough of this stuff, and we have no control over where the rest of it comes from. This situation has also forced a massive change in language. For decades, silver was dismissed by officials as a barbarous relic. Now, almost overnight, it's being labeled a critical mineral. And that word change is a huge deal, because the second you classify something as critical, you open the door for the government to step in with all sorts of controls, allocations, even rationing. So let's tie all of this together. What do these high-level financial maneuvers and political meetings actually mean in the real world? Well, we're starting to see the real-world signs of a physical shortage that you can actually see for yourself. Think about it. Costco, which is one of the biggest silver retailers out there, suddenly slaps strict limits on how much you can buy. The U.S. Mint comes out and says there's a 1-month delay on new silver eagle coins because they just can't get their hands on enough silver. And back in the futures market, traders aren't interested in paper anymore. They're all fighting to get their hands on the physical metal right now. These are not signs of a healthy functioning market. They are signs of rationing.
And so this whole situation leaves us with one powerful final thought. The powers that be can change the rules of the game with the stroke of a pen. They can change the numbers on a screen. But you can't print a silver mine. The core conflict here is between paper promises and physical reality. And the ultimate question we're all left with is, what happens when the physical supply actually runs out?